Yo, what's up, you guys? Welcome back to another video. And in today's video, I want to just dissect the fundamental data in terms of Powell that had spoken last night. And I want to educate you guys exactly how you can use this report and implement it into your technical analysis, what this means for the dollar index and the stock market there as well. So just fundamental data. So grab a seat, grab a pen, piece of paper, because the class is now in session. If you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please smash the thumbs up for the YouTube algorithm, and let's try and get this video to at least 100 likes. And also let me know your thoughts in the comments below there as well. Now, yesterday, as we know, Powell basically came out and Powell said, you know what, okay, that we are probably going to hike interest rates lower, and the Dow Jones, as a result of that, we saw pumped up over 300 points. Now, if you are a retail trader, then yes, you would have probably been selling the market at this level, because that, at this level, because that's what retail traders do. And yes, that is exactly what happened. But because they know the retail traders got that stop losses over there and everyone was taken out also. But the Dow Jones rallied over 300 points on the news. Now, if you're sitting there wondering, but why did that happen? And I'll tell you exactly why. The first thing that you need to understand is that there is a negative correlation between the dollar index, which is this one, the dollar index, and the stock market. So there's a huge negative correlation between DXY and the stock market, which is the NASDAQ, US 30, which is the Dow Jones, and the S&P 500 there as well. What this means is that when the dollar index increases in value, the stock market decreases in value also. There's also a negative correlation between the dollar index as well as gold. So basically, when the dollar index goes up, gold goes down, the stock market goes down. And when the dollar index goes down, gold goes down and the stock market goes down. Sorry, if the DXY goes down, gold goes up and the stock market goes up as well. So why does this happen? Because the Fed had hiked interest, had said that they are going to reduce their interest rates. Now, it's very important to keep in mind from an investor's perspective. Investors tend to invest in currencies that has got higher interest rates, because the higher the interest rate, the better the return on their investment in that country. There's a saying that in order to measure the strength of a country's currency, you need to look at how well the economy is doing. And that is basically an indicator that investors use to know in which country they want to invest. And they tend to invest in currencies which has got a higher interest rate for a better return. So when Jerome Powell came out yesterday and he said that smaller interest rate hikes could start in December, investors was like, okay, but then we do not want to be here for now. So we're just going to take some of our money, because this means that the dollar index is going to depreciate in value, and that means we could be, the value of our investment could start depreciating. So what they do is they go and invest into the stock market. Now, another reason for this is basically when the dollar decreases in value, the stock market increases in value, for the simple reason. When the Fed goes and when they hike interest rates, this puts a lot of strain on consumers because their debt starts to increase, and that means they have less money available to spend. Now, the reason why the stock market goes down with this, the reason why the stock market goes down when interest rates goes up, is basically because people doesn't have money to spend. And if you understand how the stock market work, or the indices, as most of you know it, it's made up of the NASDAQ, the Dow Jones Industrial, and we're going to focus on the NASDAQ in particular. The NASDAQ is a composite which is made up of 100 tech companies in the USA, mostly Amazon, Tesla, Google, all of these companies. And these companies generate a revenue through consumer spending. Now, what happens is that if you hike interest rates, what you do is you put strain on consumers to spend, to have less money available to spend on these companies. And as a result of this, these companies' valuation tend to drop, because they're not making as much profit to sustain as much people as they would in the past. And this is why you saw a lot of companies had to let go of people, especially companies that are listed on the NASDAQ had to let go of people because interest rate hikes had put a lot of strain on them because why it discourages consumers at the end of the day to spend less money, and that means they make less money. Now, when the Federal Reserve came out and they said, you know what, we are not going to hike interest rates as aggressively, the investors went, okay, then we're not going to invest into this currency anymore. What we're going to do is, now that we know interest rates are not going to be hiked so aggressively, what we're going to do is we're going to go to to the NASDAQ. For instance, let's go to the NAS 100. We're going to go to something like the NAS 100. This is the analysis that I did the other day. We're going to go to the NAS 100 and we're going to start buying or investing our money into the NASDAQ. Why? Because with a lower interest rate means that consumers will have more money available to now spend on these companies. Basically means that consumers will have more room to move ahead. And this is why the stock market tend to move up because, this is why the stock market went up when Jerome Powell said we can expect a lower interest rate hike there as well. And if you quickly take a look at the dollar index from a technical perspective, you can see the market had also printed what we can see over here, which is a head and shoulders pattern. Now, this is normally considered a bearish pattern from a technical perspective. Now, next up, we can see here, he did caution that monetary policies is likely to stay restrictive for some time until real signs of progress emerge on inflation. Now, how do we interpret this? Basically, he says that even though he's signaling that we could potentially see a 0.50 basis point hike, there is still a high probability that we could still see a 0.75 basis point hike. And the way that you can basically forecast this is there's two key things that you can look at. The number one thing to look at is the unemployment as well as the NFP, or the non-farm roll chains. The way you look at this is that you want to see unemployment go up. You want to see people losing their jobs. And the reason for this is, if you're sitting there going like, yeah, but why do people need to lose their jobs? The reason for this is because basically Powell had said, a couple of months ago, he said that, because of the interest rate hikes, we are going to see a lot of people losing their jobs. And the reason why I'm expecting the unemployment to increase or to stay at 3.7 and to get less jobs than what we had the previous month is basically because a lot of people had to let go of a lot of their employees. If you've watched the news, you would have realized that a lot of companies had to let go of their employees. And this is basically of the strain or the pressure that the continuous 0.75 basis point interest rate hikes had put on the company. And if you look at the stock market, you'll see that they're heavily overextended to the downside. They have lost a lot of money throughout the process. So in order to get inflation back down, they obviously had to let go of their people, because the Fed then continued to hike the interest rates. And that's why I'm expecting the NFP data to come through less than what it was last week until we see inflation, and we would use this a higher unemployment data and or negative NFP data as well as a negative CPI data. If we get a negative reading on both of this, then the Feds is 100% going to hike interest rates at a 0.50% basis point. However, if the unemployment has decreased and the CPI had increased, then there's no way the Feds could hike interest rates at a 0.50 basis point, because that would take away from what Powell said when he stated that the monetary policy is likely to stay restrictive for some time until real signs of slowing of the inflation cooling down has shown. So two key things to look out for is a higher unemployment, less jobs than last month, and as well as a lower CPI reading. If the CPI comes through higher, it means that CPI is higher, which is probably what we're going to see because of Black Friday and consumers were spending it like crazy. But these are the two things that we're going to look out for. And this is the two scenarios. If the CPI data comes through higher than expected and the unemployment data comes through and the unemployment comes through lower, then that basically means that the Fed is going to have to hike the interest rates. What this means is that you can expect the dollar index to go higher or increase in value, because that means that the Feds are more likely to hike interest rates, thus attract investors to a higher interest rate return on their investment. The second scenario is that if and only if the CPI comes through lower and the NFP comes out and the more jobs were added, then you can expect the Feds to lower the interest rate, and that means that it will come through at a 0.50 basis point. And what this will do is that this will then send the dollar index to the downside, and this will move the stock market, which includes the Dow Jones, the Nasdaq, as well as the S&P 500, to the upside. Now, basically, the most important thing that you want to look out for here is the CPI data. Like I said, if the CPI data comes through higher, you can expect the dollar index to increase, and you can expect the Nasdaq, the Dow Jones, and the S&P 500 to decrease. If the CPI data comes through lower, it means that inflation, or there's signs of inflation cooling down, and that means you can expect the dollar index to go lower, Nasdaq to go higher, the US 30 to go higher, and the S&P 500 to go higher there as well. But the only way to make this conclusion, ladies and gentlemen, is I will first wait for the NFP data to be released. That's due tomorrow. We also have the Purchasing Managers Index that's coming through today as well. And these are all key indicators that we are going to use to make a better trading decision there as well. Now, I hope you guys enjoyed the session. I want to say thank you for your time. Thank you for the support. And as always, cheers for ears.